Hi, thanks so much for tuning in. You're watching the Mutual Fund Show on BQ Prime, and my name is Alex Matthew. Now, on this show, we've taken you through a wide range of investment options, but we haven't often spoken to you about real estate. Is real estate a good investment option? That's not exactly the question we'll be delving into on this conversation. Rather, we'll be talking about the fact that mutual funds are increasingly investing in real estate through real estate investment trusts or REITs. And you, as an investor, have always had that option of buying into REITs directly. So, we'll be talking about whether or not you should take exposure to real estate through multi-asset funds or through other mutual fund schemes, or whether you should buy into REITs, and we'll help you understand how REITs work as well. Joining me for this conversation, I have Hemant Rustagi, who's the Chief Executive Officer of Wiseinvest, and Mohit Gang, the founder of Moneyfront. Thank you so much, gentlemen, for taking the time. Now, let me throw the question to you first, Hemant. A lot of mutual funds increasingly taking exposure to real estate through this REIT opportunity that is available. First of all, could you take us through which mutual fund schemes generally do this, and what, according to you, is the best way to take exposure?
Well, Alex, I think mostly, when we're talking about mutual fund taking exposure in REITs, usually you'll find that the multi-asset funds will be taking exposure in REITs because, as per the SEBI definition of multi-asset funds, they have to invest at least in three asset classes. So maybe you will see a combination of equity, debt, gold, and even real estate. And I think again, as per the SEBI mandate, the minimum investment for each of the asset classes has to be 10%. So usually you will find exposure to REIT in the multi-asset funds.
So, and then I'm going to throw this question to you as well, Mohit, about investments into real estate. If you look at REITs purely versus investments through mutual funds into real estate and to REIT, which allows you to take bite-sized portions of real estate rather than the chunky investment that it normally is. What do you think about that?
Look, Alex, I think as a matter of regulation, mutual funds are allowed to invest only 10% of the overall product's NAV into a REIT, right? Or they can have at best 5% exposure in a single issuer, which to my mind is not a very substantial investment. 10%, yes, it's good for the sake of diversification. And as Hemant said rightly, that multi-asset funds have been incorporating a lot of REIT and InvITs in their portfolio. That's just to give a flavor of this investment. But as of now, though there is one index which has come up, NSE has come out with a REIT and InvITs index very recently, but there's no pure play mutual fund product which has a complete underlying of REIT, barring one which I recall, which is a Kotak Global REIT fund of fund. That was a long back an ING product, and Kotak kind of inherited the product and still in vogue, but it's more an international REIT product on Asian markets. Right, but there's no proper mutual fund which gives you an exposure into Indian REIT or Indian real estate market per se. Then to answer your question very specifically, to my mind, if someone has to really take a full size bite into real estate segment or property market in India or commercial market, then one has to go pure play REIT and not through the mutual fund route. Mutual fund route can be good for starters, but it's not a full-fledged way of taking exposure into this product.
Okay, so then from that perspective, assuming that both of you gentlemen are on the same page here, let's delve a little deeper into real estate investment trusts, because there's been a lot of action in this space in the very recent past. We started off with this conversation on REITs several years back, but now we have quite a few options. So first, let me throw the question to you, Hemant, just to set the context for this. What are REITs? What is the primary purpose? And how do they work?
Well, Alex, as we mentioned about, look at exposure to real estate through REITs. An important aspect for any investor when they're designing or working out on the portfolio asset allocation, diversification obviously is very, very important. And real estate obviously plays an important role for more than one reason. But the problem is that, when you want to invest in real estate, buy a property yourself, you need a large sum of money. There are, very difficult steps that you need to take in terms of looking for a property and then going for registration, then additional costs. Then there are risk of investing in, under construction properties. illiquidity. So there are a number of issues. That's why most investors overlook uh, including real estate in the portfolio. That's where I think REITs have an important role to play. So REITs basically are an entity that allow investors to take exposure to real estate with as little as 10 to 15,000 rupees and in a very, very simple manner. So I would say structurally they are more like mutual funds. As we see in the case of mutual fund, where mutual fund asset management companies will float funds, and there is a professional fund manager who's managing your money, and the underlying in the mutual funds can be equity, debt, gold, or even real REITs that, as we mentioned. Similarly, even in the REITs, there is a designated fund manager who takes decision on your behalf. The underlying, of course, is the real estate projects. But it's important to understand that when we talk about REITs, they are allowed to invest only in the commercial properties. As of now, they can't invest in residential properties. So there are three-tier structure. There is like in the mutual funds. There is a sponsor, there is a trustee, and there is a manager. And I think a couple of important regulation. It's important to understand what REITs can do and what they can't do. SEBI has mandated that 80% of the investment have to be made in commercial properties that can be rented out, which means they have to be ready for possession, and the 20% can be invested in under construction or even can be held as stock or bonds. The second is that REITs have to distribute 90% of their net rental income to the investor. Okay, and third is that the REITs have to be compulsorily listed on the exchanges, which means that they have much better liquidity than buying property yourself. So, like I said, it's an entity that allow investors to invest as small as 10 to 15,000 and take exposure to real estate.
Absolutely. And considering that traditional conversations about real estate have always involved, usually for the average guy or the average household, taking on a significant amount of debt because of the kind of ticket size that you see in real estate, this allows you to take a slice of exposure specifically for investment purposes. But let's talk about the options available right now as well, Mohit, because in the recent past, in 2023 itself, you saw a new REIT that allowed you to take a slice or take an exposure to the retail market, as it is called. So investments that will generate income from malls. So what are the options available right now, and how does the landscape look?
Look, Alex, I think the discussions around REITs started happening in the Indian ecosystem as way back as 2008. But it took almost a decade for the first REIT to come in play. And it was only in 2019 that the first REIT came into being, which was the Embassy REIT. The promoters or the sponsors, as we call them, is the Blackstone group out there. And that is, in fact, today, it's the largest REIT in terms of the area under development. So they, I think, boast of almost 40 million square feet kind of an area, a little more than that, which is under development. They are specifically into commercial spaces. So that's the first and the oldest. The second one to enter this market was Raheja's REIT, which was Mindspace. Mindspace is owned by K. Raheja. The sponsors are K. Raheja group entities, basically. And again, mostly into commercial spaces and more into IT parks. The third one, which came, which is from Brookfield Asset Management Company. And again, the core domain out there is commercial spaces. And the recent one, which as you rightly mentioned, Nexus Select, that's the first REIT which came last month into consumption centers. So their portfolio is completely different from the previous three REITs. They own retail malls, they own even some hotels, and they own hospitals also. So which is a very, very different kind of portfolio which they bring on table. So these are the only four options available. I think in combined, all put together is not more than around $12 billion of market cap. So the Indian REIT market is fairly small. And these are the only four players right now which are available on the exchange.
Okay, so well put, and that kind of again sets the context and tells people what is available. Hemant, could you explain how the gains from this would work and how they would be taxed? Because my understanding, and I'm sure a lot of people who are broadly familiar with REITs would think that you hold this and rental income would be your primary source of income generation, right?
Yeah, true. I mean, as I mentioned, 90% of the net rental income has to be distributed. So obviously, the distribution yields are very, very important when you're investing in REITs. But REITs usually will give you return in two or three different forms. So there can be rental income, which we talked about interest. There could be a dividend or also the capital gains. So the rental income or the interest that you get is basically taxed in the hands of investor at your marginal tax rate. Second is the dividend taxation obviously will depend upon how REITs SPV has adopted whether it has opted for the lower tax regime under Section 115BAA. If that is the case, then the dividend is taxable in the hands of investor. If they have not, then the dividend is tax-free. The capital gain is taxed. Long-term capital gain is after 3 years, which is taxed at 10%. And any short-term gain within 3 years is taxed at 15%. So I think there is a significant change that was announced, actually, amendment in Finance Act 2023. What had happened was there is a loan repayment that comes back to you as an investor. In the Union Budget 2023, Finance Minister had announced that it will be taxed at your marginal tax rate. Obviously, the industry wasn't happy about it. They made a representation. And when the Finance Act was passed, it was amended. So what it says is that the loan repayment, which is made to the investor, will be reduced from your cost of acquisition. Let me just explain that. I think that's a very significant thing from the taxation point of view. So, for example, if your cost of acquisition is 400, and if you sell, let's say, after 3 years at 500, and during this period, if there is a loan repayment of, let's say, 50 rupees, the 50 rupees will be reduced from 400, which means your cost of acquisition will become 350. And your then 150, the difference between what you're selling at and the cost of acquisition is your capital gain, which is taxed at concessional rate. This is very significant, which means that as long as the money that is being reimbursed to you as loan repayment is less than the cost of acquisition, you get the benefit of that. It's not taxed to you. So I think that's a significant thing. So these are the ways you get your income or return from REITs, and this is how they are taxed.
Okay. So and it is a little bit involved in the sense that I'm actually curious, Mohit. Have you studied about the dividend distribution and the tax implications for the existing REITs? Is that dividend taxable in the hands of the investor?
As Hemantji rightly said, look, it's a slightly more complex than what it comes out on the face of it. To be very honest, I think as an entity, it's a pass-through taxation which the REITs enjoy. But dividend, prima facie, at a very broad level, if you kind of see the receipts which have been coming from these three REITs, mostly it's tax-free to my mind. But as there is one particular clause which Hemantji rightly put out, which is a very specific thing, but I think it's more nuanced. At a very broad level, I think dividends are tax-free.
Okay.
So I think for a normal investor, I think that's what one has to take.
Okay, let's discuss pros and cons, and then finally we can get into advice as to how one should take a position in this. What, according to you, Mohit, are the pros and cons?
Look, I think it's a very nicely professionally managed setup for investors who really want to take flavor of commercial real estate, right? And I distinguish here between commercial and residential. All of us individually would have perhaps tried investing into residential real estate or would own our own houses or thereabouts, right? So we have some flavor of it, some touch and feel of it. But commercial is not everyone's game, right? So you need a professional manager. If you really want good rental income, if someone wants to plan for his retirement, someone wants to get good fixed income, basically at a very, very regular interval and without any interruptions, then I think REIT is a very nice instrument. Worldwide, it is highly acclaimed. In fact, US market has over $1 trillion of listed REITs. So it's a good setup to take smaller bite-sized positions into commercial real estate, or as the market grows, you will find more consumption centers, you will find more retail malls and everything coming into the ambit of this. So if I today want to buy a part of a hotel or a hospitality chain or a hospital, it's all possible through buying units of a REIT. It's listed, liquidity is good, There is the price discovery is there on the exchange. The rental yields are fairly robust right now, currently in the range of around, it varies. So I'll put a slightly broader range from a 5.5 to 7.5 is the broad range where you can anticipate your regular income to flow from, right? And I think for someone, so these are all the pros. In terms of cons, I think, look, the net asset value, which actually determines the underlying property, is real worth, is declared only twice a year. Even on the exchange, when you go and sell, the liquidity can become sometimes kind of an issue. The underlying property portfolio, we are not experts in commercial properties. We will never know what the legal encumbrances are, what the real status of those properties are. Plus, you have to track a lot of different matrices when you track a REIT. You have to track what is the ongoing rental yield of the projects and what is the value, average value or expectancy of the leases to finish. So basically, roughly from 5 years to 7 years is the average lease tenor of all the 4 REITs which I kind of mentioned before. So you have to track this average lease expiry years as to which REIT is following what kind of an model and how long is the expiry there and what are the renewables out there and what are the new lease contracts which they are signing and what is the area under development. So it's really complex if one really wants to understand the nuances of it. Easy to do, but complex if you really want to get into it and understand the finer prints of it.
Fair point. Would you like to add anything to that, Hemant, or would you like to jump straight into the strategy someone should employ? And we've established that this seemingly is the best option available to the average investor if they do want to take advantage of the real estate story in India.
I think Mohit has covered practically, I think, all the pros and cons of investing in REITs. As for the strategy is concerned, I think it all begins with whether there is a space in your portfolio for real estate. I mean, in what form you want to do it comes later. So if you believe that you want to build a multi-asset kind of portfolio that we talked about earlier, then obviously this is the best route for you. Okay, and we did talk about whether the route should be through the multi-asset fund or directly into the REITs. There's one point I would like to add is when you're doing it through the REITs, through the multi-asset fund, I think the exposure to real estate becomes incidental. Okay, sure. Because only 10%, and if let's say your portfolio 50 lakh and you invested 2 lakh or 3 lakh in a multi-asset fund, I mean, there's hardly any exposure that you're getting.
And the multi-asset fund, just to complete that point, does not replace the need for asset allocation. So you can't only invest in a multi-asset fund, no, Hemant?
Oh, absolutely, absolutely. I think unless and until you only have multi-asset funds in your portfolio, 3 or 4, then you can talk about asset allocation. But otherwise, you're just adding one more fund. It doesn't really help you in any way in your asset allocation. So my point is that if you want to have exposure, then obviously it has to be directly investing into the REITs. Second is, I believe that only a part of your debt portfolio should come out of it. It could be maybe you want to generate some regular income, which also you will not be able to get through a multi-asset fund. Okay, so when you're investing in REITs, you can get a regular income. So my belief always is that if you're looking at REIT, first find out whether there's a space. Second, only the part of debt portfolio should go into that. It can't replace your equity portfolio. And I think usually, if you're investing in REITs, the time horizon should be at least 3 to 5 years, not less than that.
Okay. A final word. I'll throw it to you, Mohit. We're talking at a time when we're just ahead of the monetary policy. So the assumption is that the interest rates will not change. Let's see if that ends up being the case. But I think a lot of people are viewing this as the peak of the interest rate cycle. So I'm asking this at the end of the conversation because I said that I would at some point, ask the question about real estate as an investment option. And I think the first thing that people think of is residential real estate. And often on these programs, we've talked about not considering the home that you live in as that investment vehicle. Maybe it's a second home that you think of. But residential real estate versus commercial real estate through REITs, would you have a view on that?
Okay, look, a tough one, Alex. Honestly, I think, first of all, I'll take your point on the interest rate. Look, there's one very peculiar thing when people would have observed who track REITs for last 2 years, REITs haven't done well at all. there has been a lot of price correction, and that's particularly in a rising interest rate scenario that typically the REITs take a kind of beating, because people find a lot of fixed income avenues which can replace that kind of rental yield which REITs give. Even today when you're talking, the rental yield which these REITs are offering, or the yield in the hand of the investor, is replaceable with debt instruments, right? It's only in a low interest rate scenario that people would find these attractive. So I kind of endorse what Hemantji said, that it has to be a long-term product. It has to be specifically a debt replacement or a fixed income replacement. It can never replace equity and can never create wealth for you, right? And to answer your question specifically on the residential versus commercial thing, look, yeah, as I told you at the start of my thing, that residential is something which we all can actually opine on, right? Even though I might not know few things about property, I'll still have one opinion on a property here and there. But commercial is something which is out of context, which is out of syllabus for most of us. And it's, to my mind, if you really want to take a chunk of it, then REIT is the right way. It's a great allocation in any fixed income portfolio for a fairly long term. You want stability, certainty. I think Indian commercial market is yet to see the big boom. The IT sector is just about exploding, and you have a lot of SEZs coming in, a lot of business parks coming in, huge hospitality chains and everything. And I think a lot of global players will enter this market. Considering what has happened in US, I think there is a huge market available for REITs in India, and people should consider REITs and InvITs obviously as part of their asset allocation.
Maybe we'll have to have a separate conversation about InvITs down the line, but for now we've covered REITs. Gentlemen, thank you so much for taking the time. Viewers, absolute pleasure bringing you this program. Do write to us, and I'm sure that if you have any questions, we'll reach out to the experts and they'll be happy to help you out. Do stay tuned. This is BQ Prime.